On the podcast with us today is Joseph Bramante. Joseph, welcome to the podcast.
Thank you. Thank you. Glad to be here.
Well, Joseph, I want you to kind of get us started and kind of tell us a little bit about you and your background in the multifamily space as we get started. We're going to be diving into a property you guys acquired this past February 21st, called The Edge at Independence Heights over in Houston, Texas, and with your company called TriArc Real Estate Partners. So give us a little bit of a background about you and your interest in this multifamily space.
Sure. So had a unique entrance into the industry. Started off in the oil and gas industry. Was spent 5 years with ExxonMobil. Got my engineering degree before that, and purchased the first property just kind of as a hobby. And one thing led to another, and that first property ended up being the one that tried its thing is to take me down. And it was a fight for about 3 years. And by the time I surfaced up for air and figured I kind of have a knack for it. And so went on and, after the success of the first one we did, was a property that probably should have lost and ended up making over 200% return on it, and used the success on that one to raise capital and buy additional deals. So this property we're talking about today was our sixth acquisition. And then along the course of all that, obviously it's not just me doing this. I've got a full team of people behind me. I'd met my two partners, Deborah Newsom and Carrie Brenneman on that first property, and it was it was a challenge. And so they kind of proved themselves on those first couple of properties, and we were doing these just massive value add deals in the beginning because that's what was available. We were spending. The first property was about $30,000 per unit, and then on a renovation, and then the next one was 20 something, and 17, 14, and the big value add stuff kind of started going away, and now we're spending $2,000 and $3,000 a door, and it's not as exciting as it once was, but still profitable. The margins are a lot higher than it used to be.
Probably not nearly as much work either, huh?
No, not literally. I mean, this latest acquisition, the rehab was a bit boring, so it's really just kind of like 3 items, and you can count them off on one hand, and you're done. So it's not really, before we had that schedules and spreadsheets and track all the work orders, and it's a lot of moving parts, and now it's, not that way.
So tell me a little bit about where you found this deal, because obviously, this is over 100 units, so a little bit different ways to try to find these types of deals. You being in Houston since 2011, acquiring these, I'm sure you might have already built some relationships in the community. So how did you actually find this project?
Yeah, so this one was kind of one of our go-to brokers. As a broker, that this was actually our first deal, buying deals from him. But we've been in constant talks, and we knew that. One day we would end up buying a deal from him, and we've actually had the deal before this that we purchased was a deal that he originally showed us, and then it got repackaged by another broker. Of course, they added a little bit to the price and then sold to us. So after that last deal, we learned, actually he does give us pretty good deals, and we didn't want to go through the markup of a more kind of premier broker. So we bought it straight from him, and actually we passed on it the first time. We were looking for much larger properties like we are now. And this one didn't really fit the specs. It was, 112 units. It wasn't really, as far as unit count goes, the smallest we like to go is about 150. But it was next door to a property that we already owned. It was in line of sight to the other property. So for us, we kind of waived our parameters there on the size because of the location and the ability to run it as a larger property and be able to have those economies of scale, which is why you're looking for larger properties to begin with.
Now, when you passed on this project the first time around, did you already have that other asset there as well, or had you acquired that one and then you thought the 112 one might work now?
It already had the other one. We purchased the other one, 2 years prior, and
Okay.
just finished the renovation. So we were very comfortable with the market. We knew that profile very well. And this one, we approached the owner. We made an offer. The initial, their counter was significantly higher. And so we just didn't even bother to negotiate. We just went on with other deals and circled back to them, 6 months later, and they were a bit more negotiable.
Okay, cool. And so this was the first time buying it from this particular broker, and they kind of knew you had some of the properties there. And was there anybody else on this particular deal bidding with you, or was it pretty much you as the only one on this one at that point?
Yeah, I mean, we don't think there was. I mean, you asked them and there were, but we don't believe there was.
They played that card of, well, somebody else might get it or something, and kind of increase it a little bit.
Yeah, that's the classic broker routine. But no, it was actually a unique transaction because the only time we even spoke to the broker was in the very beginning, just to show us the deal. And then after that, we were interfacing direct with the owner, which is something that we hadn't really done in the past. But also this owner was an attorney, so it would made us a little, we were a bit more cautious because, they're attorneys.
So how did that work? Because you're right, because normally you don't talk to the owners at all, maybe on a buyer call, like as an interview or buyer interview. But other than that, you're communicating with either the legal, the buyer's legal, or the seller's legal, or through the broker.
Correct. It was awkward, to be honest. It was certainly awkward, and you're like, man, this is, and he was, not making any attempt to send communications through the broker. He wanted to communicate directly. So we said, sure. And so, it helped with negotiations. I mean, that is the one perk is that, it's hard to negotiate through an intermediary. So you can make all the demands you want to your broker and try and get lower price. But then they're going to take whatever language you're using and they're going to twist it to be received better by the seller. So in this case, we were able to communicate directly with the seller and use our negotiating tactics to get the price we wanted.
So did that, was that broker just lazy, or is that like the preference of the seller?
I think, I don't know. I would guess preference of the seller.
Okay.
But it could have been either way.
Yeah.
Yeah. I don't want to say anything bad about the broker. We have a lot of respect for him. He does well, but yeah, it was just certainly our first transaction with them, and it was a very hands-off kind of transaction, but it could have very well been the seller, particularly because we just looked at another deal he was selling, and he's brokering the deal himself. So considering that, I think that it probably was the seller.
Okay. All right. Yeah. I don't know how I would handle that too. I would definitely feel awkward because you're right. You usually go through the broker, or you never usually go in direct with the seller, but thankfully it worked out on this one.
Yeah. So it was strange. It's one of those things that you always wish that you can talk directly with the seller, and then when you get it, you're like, this is kind of weird.
Yeah, it's like you get what you really want, and then it's like, how do you actually respond, or how do you actually react with that? It's kind of challenging. At what point, when you were first presented this deal, did you actually tour the property?
We toured it 6 months later. So after we passed the first time, that's when we toured on it. When we offered the second time is when we toured, just because if you're so far on price, don't bother waste your time. So we wanted to see on that initial offer if we were in the ballpark on price, and we weren't. So we said, all right, good luck.
So you submitted an LOI at a price that you wanted to kind of start the negotiations at, and if they were agreeable to something around those numbers, and you would take the extra effort to go tour the property.
Correct. Yeah, we were, ironically, we ended up closing right at the number on our original LOI. So that was nice, but they had countered us at $1.5 million higher on 112 units. So it's, a significant amount, and we chose not to pursue it.
Well, sounds like we're going to get some interesting stories and tidbits through the rest of this interview. So, so when you were negotiating the price, when you were touring the property, did the broker give you the tour, or did the seller?
So, again, the seller. The last time we saw the broker was when we signed, was actually whenever we got the documents.
Okay.
Submitted the LOI, and then somewhere along the course of the LOI going back and forth, the seller stepped in and the broker went away. And that was the last we heard from the broker. And he would check in every now and then just to say, hey, is the deal closed? I want to get paid. And that was it. So it was a really kind of strange situation.
Man, well, so when you were giving the offers back and forth here, how many rounds of offers back and forth did you go through?
It wasn't that many. I think it was like three, and it was, we actually walked from the deal because, again, a third time, because we had agreed on a price which was 11.3 million, so 300 higher than we closed at. And prior to signing the contract, we already had engaged our lenders, and we had gotten our quote matrix back from the lenders. So like the day before, we had our quote matrix back, and it wasn't anywhere in line with what we thought it was going to be. And I'm glad we really did it that early, because the assumptions that we had made kind of going in, particularly in this, you think of last year, and because this all went down last year. We closed on it in February, but the bulk of the negotiation, everything was last summer, and and dragged out under contract by December, and closed over holidays, which is a big mistake. Don't do that. But anyway, so the debt markets, as you probably recall, were changing. They were all over the place, and we didn't know what was going to happen with interest rates, and so the banks were being ultra conservative with everything. And from when we last looked at debt prices 6 months prior to, because we had an original quote 6 months ago, and then from whenever we were about to sign the contract, there was a big difference in price, in terms. So we just sent him, the seller, our quote matrix directly, and we said, hey, look, we can't do this loan. We can't do it at this price. Look at the quotes we're getting. And it was a really unique situation because our lender was the same lender who already owned the debt. So that was a whole other situation where, we both had the same exact bank rep, and he had purchased, so a little back history on us is that we're doing our first new development right now. So been working on this development for the past 3 years. So a fair amount about how to do new construction. So we know what kind of loans he's getting. So we knew his loan was a 5-year construction loan, 3 years IO and 2 years, 2 years AMP. So it wasn't really rocket science to figure out, okay, you completed this. Yeah, you started in 2013. 5 years puts you at 2018 sometime, maybe 2019. And basically through our kind of interviews with the bank, for our own personal purposes, I was able to ask some very, very surgical questions to our rep to figure out that, their loan, I mean, she couldn't say it, but when her face went red, that was the first kind of sign that, yeah, they're up against the wall because their loan's expiring. And so their options are either sell to me or refinance. And if they refinance, they're not going to get all their money out. So anyway, we were, but what makes it more interesting is that when we sent him our quote matrix, he actually went to bat for us to the bank that we're using to try and get better terms for us so that he can get a higher purchase price. This is great. Our seller's doing the battle for us. So it was a really unique situation there.
So when you were, well, let me just confirm. So what was the purchase price on the at that point?
It was 11.3 at that point.
11.3, and this is a new construction started building in 2015.
Correct. Yeah,
okay.
They started in 2013 and finished its 2-year construction process and leased up, and so their initial, they got their COs in 2015.
Okay, 2000. So it was started in 2013, but then finished in 2015. Then they went through their lease-up phase, and so yeah, I can see that when we were right around that 2018-19 mark. So you had the kind of lot of leverage there. And when you were first getting the debt quotes on this, what did the interest rate come in at?
The interest rates on this it wasn't so much the interest rates that was the issue. It was the
proceeds.
Yeah, the proceeds. We were getting really hacked on that. So I think the rates were also, it wasn't a big loan. I mean, it's $11 million, so it's not that big. But I want to say they're in like 5.5s, mid-5s.
And who did you do the lending through? Was it Fannie Mae, Freddie Mac, or was it a different lender?
So we looked at agency debt, which had just ridiculously low proceeds, and local bank. And so we chose a local bank option. Also because we had just did a deal, we had just refinanced our neighboring property with them just a few months prior. So for us, we had refinanced them to the exact same term sheet on our previous deal that we were acquiring a new property with. So, both properties would have term sheets or loans that are expiring around the same time, which gives us options, in the future to sell them as a portfolio.
And when you went with a local bank, were they giving you kind of a similar 30-year amortization, 10 years, 10-year balloon, and then several years of IO?
Yeah, we got 3 years. So this one also with a local bank, we were able to play around with the terms a bit more and buy down our debt. So we did floating rate, which was our first floating rate deal, but we did 3 years of LIBOR cap. So we have it capped at 5%, like 250 LIBOR cap with 250 spread. We paid, $80,000 up front to get that LIBOR cap. But we purchased it through the bank themselves. And so that was part of negotiation. And so we got an even lower spread. They wanted a higher spread. They were at 3 something. And initially we got them down to 250 spread. And then at the end of that, the last 2 years, it's amortizing.
Okay.
A 25-year am.
And what kind of proceeds did you end up getting it with?
We got 75%, so the 8.5.
Okay. And that's what you ended up with. What did you get the original quotes for?
They were 6.9, 7.2. They were Fannie and Freddie, which I thought would have been a no-brainer. They didn't come.
On the interest rates, they were that high?
Oh no, it's about proceeds.
Oh yeah.
Proceeds,
okay.
6.9.
What was the percentage on that though?
Oh, they were better on the on the rates. They were.
No. I'm saying, what was the percentage of the proceeds?
Oh, like 60s. Yeah.
Okay. Yeah.
Dollar amount. Yeah. It was 6.9 million. We were trying to get to 8.5.
Yeah.
So a big spread there.
Mm-hmm. Yeah. So did you, and what did you end up getting the interest rate for at the end of the day?
5. 250 spread. So, everybody's, one of the upsides on a floating rate loan is that if there is any kind of recession risk, it helps you, because if there's any kind of recession, the Fed's going to drop the rate and the rates go down, our interest rate goes down. So but we're capped. So we can't go any higher. We can only go lower for the next 3 years. So that's a safety net.
So right now you're probably lower than the 5 right now. I would assume you're probably around 4.25 or 4.5.
I haven't checked, to be honest. I haven't checked it. We've been focusing on a lot of other things on the property, just from the management side. It's just been a real mess. But I'll certainly look back at that. What the rate is.
Cool. And so you did 3 years IO on that one. So you guys is your plan to try to sell it in 5 years, or is your plan to try to refinance it and pull some of your capital out in 5 years? What's kind of the plan on the project?
So our plan is to sell them both in 3 years. Because at that point, you'll have 250 units in a great location, lots of synergies with 2 properties. Both properties will be exiting their 3-year IO period, so the cash flow will be dropping for the investors. So it makes good sense to go ahead and exit. Let the investors take advantage of that high cash flow period, and then once it starts paying principal for the last 2 years, to use that window to try and make these 2 years to find a buyer.
Mm-hmm.
Yeah, find a buyer.
And what did the returns look like on this one as far as let's just start off with maybe the IRR.
So the IRR on this deal, we were just over 20%. I think it's like 21. Once we finished everything, that's assuming exiting. So after that, exiting in year 4 sometime. We assumed an exit at the end of year 4 because we don't know when it would actually trade. A sale can take 6 to 12 months. So we just assumed the worst case scenario and went for 12.
So it's basically the IRR on this one is basically based on a 4-year exit.
Correct.
a 4-year hold on that capital. And what did the cash on cash come in at?
The first 3 years, you're just under 8%. You're like low eights. It starts like 7.9, I believe, and goes up to like 8.3 or 8.4 for into that third year. And then in that year 4 and 5, it goes down to like 4.5%, 5%. So it's not as attractive from the investor side.
Mm-hmm. And what class property would you classify this one as?
Yeah, it's, this one, by age, it's Class A, but by amenities and what it has, it's a Class B. I've got other Class B and C properties that have way more to offer on amenity side than this one does, and have better build outs, but or better interior amenities. Sorry, granite counters and stainless steel, stuff like that. But this one is B plus, A minus. Now, when we finish with it, it'll be more of a closer to a true A minus. But for its, I think it solidly fits the workforce housing profile. I mean, it's exactly what we're needing more of. I mean, and the one thing that I tip my hat to the seller, because he's building a product that is absolutely needed right now, which is affordable. I mean, it's more expensive than it's more expensive than my neighboring property, but not by much. I think it's $100 on some units. So I think it, for those residents who want to make the jump and go into something nicer, it's a lot more easy for them to afford that versus what you think of when you see Class A, which is $400 and $500 a month more expensive than Class B and C.
And what kind of area would you say that this asset is in?
It's workforce housing area. I mean, it's a true blue collar kind of area.
So it's C class area, or is it more B class area?
Yeah, C plus, B minus. It's interesting because the area is doing well. And one of the good signs that we had, ironically, was from a property that we just lost out on that same year. It lost by, it was a $20 million property. We were the high bidder for 4 months at $19 million, and we just refused to give them 20. And then some guy from California, of course, like always, steps in, pays 20, and we lost the deal. But anyway, they increased their rent to $160 since that guy took over. And but it was a full renovation, granite counters and everything. Still not as nice as the product we have, but for taking a Class C property and spending, I think they're spending $15,000 a unit. A big rehab on it, and we're getting the rents. So, and that's a mile south of us. And so you have all of this, improvement to the, this gentrification of the demographic going on. And the biggest sign that's really kind of spurred all that was the Whole Foods they installed about 2.5 miles south of us. And so once that happened, you just started seeing properties go up for sale, and people are exiting because it's they see that they're able to sell it for a higher price because of the value that a retailer like Whole Foods, a grocery like Whole Foods brings.
Mm-hmm. Yeah, that would probably be my biggest question. I'm sure a lot of people that are listening are probably thinking the same thing, that you're always taught to try to find that C class property in a B area so you can kind of do those value add plays and those deferred maintenance, kind of bring it up. And this is kind of the opposite of that, where you're kind of buying a B product, B plus, possibly even an A minus by the time you're done, and it's in a C area. So what would you say to that if somebody was listening about and you're kind of wondering about that?
Well, for us, the value that we're generating wasn't in the rents. So very little of the value we were generating from rent growth. We were just basically following the market. I think we had 2.5%, 3% rent growth per year. The value for us was in the payroll. So we saved $40,000 a year by sharing payroll between two properties, and then the water metering. So the property being newer construction allows you to individually meter every unit for water. So you can bill back 100% of the water. And then the kicker for us was that this owner, or the seller, was billing back basically nothing for water. It was almost like a RUBS implementation, because he was billing back $20,000 when he should have been billing back $60,000 if he would have had the meters. So between the meters and our payroll, we increased the NOI $80,000, and we've done that already within the first month. So 1 month in, we increased NOI 80,000. I mean, it's gotta continue to mature, but the payroll was instant, and the water meters took 2 weeks to get installed. Now it'll take some time for the billing to catch up. Every lease already has a RUBS implementation, already has a RUBS addendum in the lease. So it's not our fault that the previous seller wasn't billing water, but legally and contractually, we can bill you for your water. And so that's the value that we saw. And then the rent was secondary for us. So for us, it was payroll, water metering, and then the office, which was our third slightly big ticket item. We were going to spend just over $100,000 to install a new build ground up an office and reclaim a unit that they were using as the office. So we were going to get just over $10,000 a year in rental income, but it was going to cost us just over $100,000. And we've since, as we got all our bids in and the permitting process and everything for that office, we just decided to scrap it and not do the office, and instead completely gut the office that's there and make it doesn't look like a unit. One of the problems that we have with the existing office is that from the moment you open that door, you realize you're in a unit. They have the kitchen, everything is there. It's very obvious that you're in a 1-bedroom apartment. And so what we're going to do is go in and tear down a bunch of walls, rip out the kitchen, everything. And so you won't be able to tell that you're in a unit. It's going to look like you're in a dedicated office, which is what we wanted it to be. Now,
what was the reasons behind deciding not to create that extra space, the separate office?
For us, it was a money thing. I mean, we were spending $100,000 and you're getting $10,000 a year in revenue. So we had budgeted $100,000. It was closer to $150 by the time all the numbers kept coming in. And at that point, you're like, that this isn't really worth it. It's a very marginal return that we're getting. And then also the location that we had wasn't. We're putting it in the courtyard, so we had concerns over visibility from the street and that of residents when they park, finding the office. You never want somebody to have to find your office. It should be very obvious where your office is. And so if we were to move it, we would have lost the ease of access to the existing office.
Mm-hmm. So, what's the going cap rate or the purchase cap rate that you bought that particular asset for?
I can't recall. I can't recall the cap rate. I want to say it was like it was 5.5, maybe 5.8.
Mm-hmm. So I'm just kind of running the numbers in my head and just playing devil's advocate here. So let's say you spend $150,000 to do that, and you're cash flowing $10,000 extra a year. If you've increased the NOI by $10,000, which I know would be the exact number, but you've increased that value on a 5 cap by $200,000, but you've also
like $175,000 at a 6 cap, and so you're spreading 175 compared to 150 to build. You get $25,000 profit margin. It's not, so there's the valuation approach, then there's the cash flow approach to looking at as far as like what additional revenue is your investor getting. And so we just figured it was too marginal from the numbers perspective. And then from the actual functionality perspective, we thought it was going to be also marginal, particularly because there was a lot of large trees in front that were small now, but in the future they would be large. And so it would be challenging. But no, I was a big proponent for building the office, and it was a decision we made honestly like 3 weeks ago that we're not building that office. But I wanted to do it. We had plans drawn and everything, and it would have certainly, our current office is about 600 square feet, and the one we're building would have been about 900 square feet. So it would have been much bigger. Still not as big as we'd have liked, but big enough. And
So as far as an amenities standpoint, are you guys planning to add any additional amenities, or not additional, but any amenities at all on this particular property?
Yeah, no, we've got over $100,000 budgeted just for amenities, mostly in this one particular area. It's the courtyard. It's a giant 8,000 square foot area that's just grass in between two buildings. And we're going to go in and add, there was going to be a fire pit, but now we're thinking it's going to be a water fountain, because that's on the upkeep is a lot cheaper, and on the risk side is a lot lower. and then barbecue areas, lounge areas, lots of landscaping, a nice little walk-through trail, some pergolas, and seating areas. So we just got the bids in, or just got the design in from our designer for the landscaping 2 weeks ago, and we're holding off because the other thing that we're doing on the courtyard is we're adding yards. So a big amenity moneymaker you can add to your properties is yards. Particularly on your first floor, so only on your first floor where they have 10 to 20 feet where you can push out that gate there and give them a yard, which is 50, 100 square feet, has a big impact for them and the livability of their unit, especially if they have pets. It's a natural kind of magnet for pet owners, which then incurs pet rent and pet fees. So, there's a lot of additional indirect value that you get by having yards and catering to, or really trying to attract your pet owners. You can charge, upwards of $50, for yards. I know my mentor charges $75 to $100. And so for us, we went in and we identified, it was like 30. It's all of the courtyard facing first floor units and all the first floor units in the back of the property, because those have the potential to add the biggest yard. And so we're going to be, they're 10 feet out from the building, and then they're as wide as we can go, and not include the AC system. And then just outside the yard on that courtyard will be the rest of our landscaping. So it really kind of helps us twofold, because one, we can charge for it, and two, it's less area that we're having to pay to landscape because it's inside their unit basically.
So let's shift here a little bit and talk about the due diligence process. Obviously, this is a newer build product, but is there anything crazy come up during due diligence?
During due diligence, we had some really weird electrical issues that we were trying to troubleshoot. But otherwise, just that, I guess pay attention to the light bulbs that people use. These guys had wired everything with the little 2-prong kind of halogen bulbs, which cost, a bit more than your regular LED or even your generic incandescent bulbs. And for some reason they kept going out. And so they replaced a good bit of them. But other than that, on the due diligence, it was actually pretty easy. Most of our time was spent focusing on getting that, or at least for me, was spent getting the debt. And that's, part of the beauty of our team. I don't have to worry so much on the operations side. So our whole team, they went in, they walk every unit, they do the lease file audits, they do all that while I'm on the side working on the debt. So in parallel, we're doing the two things, then we kind of reconvene. And so from their end, though, it was, they had some unique situations because their manager watched us. I mean, on one perspective, the lease fallout was great. Their files were really well organized, which says a lot. I mean, our partner Carrie was just like really impressed with the organization and how every file was structured, and it was cleaner than anything she'd seen in the past 30 years. So, which is strange, particularly because all the problems we had after closing with their files, which I'll get into in a moment, but. During that whole lease file audit, though, their manager was just sitting right there in the office, which is not something you typically do, because it's just strange. You're auditing somebody's files while they're standing right there, and it kind of takes away from that was one of our lessons learned, is that we're going to make sure that all future of these file audits are in private with us. You do them on their site always, but you can do it in a closed off room.
Yeah.
But no, during due diligence, it was a really kind of open and shut case for us on that due diligence. I was spending a lot of time on my end trying to get the CapEx component nailed down and choose the right level of renovation. You know this. You can very easily over renovate a property, and you need to renovate just to the level that you need and spend just the amount of money you need to get that maximum rent pop in the future.
So how much money did you end up having to raise on this project?
We raised 3.6.
3.6. And how did you structure that with the investors?
So GPLP with a 8% waterfall. So starting at 8% IRR, it was 20/80, then 25/75, and then 70/30.
Okay. So once you hit the 8% IRR, it went to 25/80 or 25/75?
Yes. Yeah. Until 8%, nothing.
Yeah. And then after after the first waterfall, it went, what was the next hurdle?
Yeah, it was 8, 16, 24.
Okay. 8, 16, 24. Okay. All right. So that makes sense. So 8, 16, 24, and it was 80, 20, 75, 25, and then 70, 30.
Correct.
Okay, cool.
At our maximum hurdle was 70/30. Yeah.
Okay. All right. And let's see, how many investors did you end up getting on this one?
We got 40 investors on this deal. This was our largest one. And really, you asked a question about due diligence, and that for me, that last 30 days was just a fall, because I raised $3 million in 30 days. It was just a huge, just running around like crazy, like a crazy man trying to raise money. But because we did it to ourselves, because we've got, most of our investors are looking to place larger chunks of money. And so when you buy a smaller deal and you're geared for larger deals, it kind of, it forces you to bootstrap it, which is, it was nice to do it. Hopefully it was the last hurrah. And then now we're off to these, larger deals, because it's not you don't sleep for a lot.
That's very true. That's very true. So, and how long you said it took you to do? About 30 days?
Yeah, we had the first 6. We had probably 600 for months. Just from our hardcore base of investors who always just put up as soon as we open a deal. And then the last little bit was once it was, and also really what really hurt us, though, as I mentioned, was the holidays. We put this under contract December 10th. And so we went right through Christmas, New Year's. So people don't really come back to the office and kind of get back in gear until late January.
Mm-hmm.
We lost almost 60 days through the holidays, and it was, we paid for it. So for now, our new shut off is November 1st. If we don't have anything under contract, we're done.
Yeah, it definitely can be more challenging. We actually raised for 2 deals in December, we had closed on a deal in December and closed in one in January, and it was definitely a little more challenging during the holidays. But if you definitely stick to it, you can definitely get it done. But you're right, it can definitely increase your stress level for sure.
Absolutely. Yeah.
Well, Joseph, I want to thank you for taking the time to be with us here today. For those who are listening that might want to reach out to you, get some more information from you about this particular project, or maybe some future opportunities that you have, how can they get a hold of you?
The easiest way is to go straight to our website, TriArc Rep, so TriArcRep.com. Or you can shoot us the email, info@triarcrep.com. Or you can call me, 281-836-4181.
Great. Well, Joseph, thank you again so much. Look forward to having you on another episode as you continue to close more properties, and hope you have a good rest of your day.
All right. Thanks, you too.